Welcome back. A brief recap on what we have done so far. We introduced the concept of a systematic relationship between the risk factor and the value of the account, be it an asset or a liability or an operating income. The necessity of a systematic relationship is there, because if there is no relationship between the risk factor and the value of the account, then there is no question of that particular factor being a risk factor for that particular account. It is only when the risk factor or the fluctuation in the risk factor influences the value of the asset that it constitutes a risk factor. So, when we talk about hedging, or when we talk about risk and the management of risk, a systematic relationship between the risk factor and the value of the asset is implicitly understood. What is a systematic relationship? We have talked about regression. Now, systematic relationship implies that a change in the independent variable would result in a predictable change in the dependent variable on the average. The on the average constituent is within inverted commas is with emphasis. It is not that every change, for example, let me illustrate this. Let us say we have a regression equation y is equal to beta x plus alpha. Now, let us put values also. Let us say it is 2x plus 3. Now, suppose I have a certain value of the independent variable, let us say x is equal to 2. It does not necessarily mean that y will take the value, or y would have taken the value 7. It does not necessarily mean. Y could probably have taken a value which is pretty close to 7, but may not have exactly touched the value 7. Now, that is when, but if these observations were taken a multiple number of times, sufficiently large number of times, then on the average we would have got the value 7. That is what we mean by a systematic relationship. That is a relationship which holds over a sustained number of observations. That is important. A particular observation may deviate, a particular observation for a given value of x, the value of y may deviate from the predicted value of by this regression equation, because when we talk about regression, or when we use regression, in fact we are talking about stochastic processes, we are talking about random variables. So, there could be some other factors which also contribute to the change in the value of y, and that change that those other factors which we have not explicitly enumerated, or the influence of which we have not been able to capture in our analysis, are represented by a term which is usually called EI, or the random error term, and this random error term is the manifestation of the ignorance of the precise functional dependence of y on all the factors that contribute to its evolution. So, that is systematic relationship. Systematic relationship is a relationship which holds over a sustained number of observations, but may be violated when we talk about a specific observation. That is important. Then we talked about exposure. Exposure we defined as the slope of the regression line, that is beta in this case. It gives the sensitivity of the dependent variable with respect to the variable against which it is regressed. So, this x constitutes our risk factor and y constitutes the value of the asset or liability, whichever we are talking about. And how do we measure risk? We measure risk usually as the standard deviation of y, that is the standard deviation of the exposure in response to the fluctuations in the value of the risk factor. Now, then we talked about how hedging takes place by taking a position which is such that these fluctuations y due to the variability of x are annulled by that hedging instrument, by our position in the hedging instrument. We take such a position in the hedging instrument that the fluctuations in the price of the hedging instruments offset, cancel, annul the fluctuations in the value of our exposure. So, that is how we talk about, that is what is the precise meaning of hedging. Then we discuss the issue of better versus certain outcomes. We said that hedging leads to a more certain outcome, but it may not at the end of the day result in a better outcome. Let us look at this a bit more closely. Look at the data that is there on the screen. We have a particular asset which is currently priced at 60 units of money, 60 rupees. The quantity is 100 units, and the spot price when we lift the hedge is, we take 3 scenarios. The spot price on maturity, that is when we lift the hedge, could be 50, could be 60, could be 70. We are evaluating 3 possible scenarios. The futures price at the start of the hedge, at the inception of the hedge, is taken as 62, and that also evolves to 50, 60 or 70 in the 3 possible scenarios. We are taking the hedge ratio, we will come to it in a minute, but we are taking, for the moment we are taking the quantity of the hedge in the futures market as the same as the spot market quantity, which is 100 units. Now, the important thing is, if the hedging was not done, if our exposure, the spot market exposure, was not hedged, you find that the change in the spot price in the 3 possible scenarios turns out to be minus 1000, 0 and 1000. That is, if the price drops down to 50 on maturity, we lose 10 rupees per kg, and since we have got 100 kg, we lose 1000 rupees. On the other hand, if the spot price of the commodity, underlying commodity, goes up to 70 from 60, we make a profit of 10 rupees per kg and a total profit of 1000 rupees. The hedge also evolves. The price of the futures also changes at the maturity of the hedge, and the differential between the price at which the hedge was commissioned and the price at which it was lifted multiplied by the quantity comes out to be minus 1200, minus 200 and 800 in the 3 scenarios that we are analyzing. As a result of this, the net change of the hedged exposure, that means the hedge plus the exposure, the hedge plus the exposure in all the 3 cases turns out to be plus 200. However, it is interesting that if the hedge was not undertaken, then there is a particular scenario. What is that scenario? That scenario is that the spot price, the price of the underlying asset, goes up from 60 to 70, in which case you make a profit of 1000 rupees. And because of the hedge, 800 units or 800 rupees of the profit is eroded. It is annulled by the hedge, because the hedge has suffered a loss of 800 rupees, and the net profit comes to only 200 rupees. So, this is what we mean when we talk, but the interesting part is, now you are having an outcome of 200 rupees in all the 3 scenarios. The value of the hedged asset turns out to be 200 rupees in whatever the value of the spot price of the asset turns out to be. However, there was a situation when, or there would have been a situation if the spot price had increased to 70, that you would have made a profit of 1000 rupees, which you are not going to make now because of the hedge. So, what does the hedge do? Hedge, when your profits are bad, in other words when you are incurring losses, it compensates you for the losses, but on the other hand when you are making profits, it also eats into those profits, and you end up with a more balanced outcome, a more certain outcome. That is what we mean by better versus certain outcome. So, hedging may not result in a better outcome, as you have seen, but hedging does result in a more certain outcome, as is shown by the yellow highlighted figures. We have talked also about perfect and imperfect hedges. Perfect hedges are those hedges where the cash outflow or the cash inflow, as the case may be, at maturity is fixed or is certain, is not subject to fluctuations. For example, in a forward contract, the cash outflow or inflow on maturity of the forward contract is fixed. So, this is a perfect hedge. Futures hedges do not constitute perfect hedges. The reasons I had already discussed and will continue from there on, in fact. So, the reasons, some of the reasons that are attributed to the futures hedge not being a perfect hedge are marking to market with possibility of change in the interest rate on the margin account, then difference in the exposed asset and the asset underlying the futures contract, which is a phenomenon which is commonly known as cross hedging. So, difference in the asset which is being hedged and the asset that is the premise of the futures contract, which are used for the hedging, cross hedging. Then as I mentioned, there is a very important thing that we must keep at the back of our mind. The maturity of the futures contract and the maturity of the hedge need not necessarily coincide. They may coincide, they may not coincide. More often than not, because futures are standardized contract and they mature as per a predefined plan, exchanges release futures contracts for trading as per a predefined program, and therefore, it may not invariably happen that our hedge period, which is specific to us, coincides with the maturity of the futures contract. We may have to lift the hedge, that is, we may have to close out our futures position before the futures actually mature. In other words, we buy the futures at a particular price, we sell the futures at a particular price, notwithstanding the fact that the futures would continue to be traded even after we close out our position. So, that is an important point. And the third point that we are going to start with today is the issue of lot size, the contract size. As you know, futures are standardized, they are also standardized in terms of the contract size. The number of underlying units or the units of the underlying asset which are covered by one futures contract is not 1, it is usually more than 1. It could be 1000, it could be 1,000,000, depending on the value of the underlying asset per unit. The exchanges mandate, now this is also prescribed by the exchanges. The exchanges mandate lot sizes, and these lot sizes are prescribed are not changeable during the life of the futures contracts. So, therefore, the issue of lot size arises because your exposure may be for a certain value, for example $3,500 US, and futures for $3,500 US may not be available. So, there would be a certain element of rounding off involved, that also contributes to the imperfection in futures hedging. However, we can work out the most appropriate number of contracts, which is precisely what we are going to talk about now. But before I get into that, again a small digression, a brief digression on the manner of calculation of the variance of a linear combination of random variables. X and y are random variables, and we have a linear combination of random variables, that is alpha x plus beta y. Alpha and beta are real numbers. So, we want to work out the variance of this combination alpha x plus beta y. So, E, please recall, E is the expectation operator, which is nothing but the mean. So, working on this, as all of you know, the variance is given by E of x minus E of x whole square. This is equal to sigma of x whole square. The variance of x, where x is a random variable, is given by the mean value of x minus x bar whole square. Some of you are familiar with that nomenclature. Mean value of x minus x bar, this is nothing but x bar, and this is nothing but the mean value of x minus x bar whole square. So, using this expression, we have the variance of alpha x plus beta y is given by E of this thing, and on simplification you simply, because alpha can come out of this expectation operator in this expression, alpha being not a random variable. Now, alpha is a real number, it is not a random variable, because its value is fixed at the time of the starting of at the time of the construction of this variable. So, it is a predetermined variable, it is a predetermined real value, and it is not a random variable as such, and therefore, it can be taken outside the expectation operator. Similarly, beta can be taken outside the expectation operator. We have done that, and then we have simplified it to arrive at alpha into x minus x bar plus beta into y minus y bar. This is nothing but y bar, this is nothing but x bar. Doing the squaring, we have when we open the square, we have this as a square plus b square plus 2 a b. Now, please note E of x plus y, or the expectation of the sum of two variables is equal to the sum of their expectations, and that is what we have done here. When we square this, we get a square plus b square plus 2 a b. Simplifying this, and again using the fact that alpha is not a random variable, we take alpha outside the expectation operator. Now, alpha square, of course, after the squaring. Similarly, beta square is taken outside the expectation operator, and here alpha beta is taken outside the expectation operator, this beta and this alpha. And what we end up after this expression, now if you look carefully at this expression is nothing but what I have written here, which is sigma x square. And similarly, this is sigma y square, and if you look at this expectation of x minus x bar, y minus y bar, the mean of x minus x bar, y minus y bar is nothing but the covariance of x and y. So, what we end up with is alpha square sigma x square plus beta square sigma y square plus 2 alpha beta sigma x y. Now, sigma x y, which is the covariance of x and y, can be written in terms of the correlation coefficient as rho of x y sigma x sigma y. So, this is a slight introduction to the concept of calculation of standard deviation of a linear combination of random variables, which we are going to use in the next slide. Now, look at this here. Suppose I have a portfolio. I have a portfolio consisting of QS. QS is the quantity of the exposed asset, the number of units of the exposed assets. It may be US dollars, it may be in terms of kilograms of wheat or whatever it is the number of units of the exposed asset. Delta S is the change in price, that is delta S is equal to price at the maturity of the hedge minus price at the inception of the hedge, that is maturity of the hedge minus inception of the hedge. This is the change in price per unit of the exposed asset. Therefore, the total change in price of the exposure is given by delta S into QS. This is the change in price of the exposure between the point that I introduced the hedge and the point that I lifted the hedge, that is QS into delta S, where delta S is given by this. Now, please note that in this particular expression, this delta S, S naught is known at t equal to 0. This is today's spot price. So, we know this. However, S t is not known at t equal to 0. See, please note that we are to determine the number of contracts at t equal to 0, that is when we are conceptualizing or when we are introducing the hedge, when we are creating the hedge. Therefore, we should know of the number of contracts at t equal to 0. Now, at t equal to 0, we know S naught, we know the spot price that is prevailing in the market at t equal to S naught, but we do not know the future evolution of the spot price. In other words, what I am trying to hint at is that S naught is known, but S t is a random variable, and therefore, their difference is a random variable, and therefore, I put a tilde here. So, obviously, this is also a random variable. The value of the exposure at the date of maturity of the hedge is also a random variable, because it consists of this which is known, this is deterministic, this is what we have in our stock, and this is our exposure, but this constitutes a random variable. Similarly, we look at the futures case. The change in the value of the futures, that is the hedge. The change in the value of the futures is given by the number of units that I have taken in the futures market, that I have either shorted or taken a long position in the futures market, multiplied by the change in the futures price, which is F t minus F naught. But please note, F naught is again known. Today's futures price at which I create the hedge is known to me, but F t is not known to me. F t has a certain stochastic evolution, a random evolution, and is defined by a probability distribution. Therefore, this whole thing is also a random variable, it is also evolving unpredictably because of this particular quantity. So, both these quantities, if you look at this total change in the hedged portfolio, that is the portfolio consisting of the spot position and the hedge, the spot exposure plus the hedge. Now, please note there is a minus sign here. Minus sign is only kept to show that Q s and Q f are opposite to each other, that is, we are hedging a long position by a short position and vice versa. You could get the same result by putting a plus sign, but there you have to account somewhere down the line, you will always have to account for the fact that Q s and Q f will need to be opposite to each other. Anyway, so the total change in the value of the hedge or the hedge portfolio as such, delta I, consists of the change of the exposure, that is Q s delta s minus Q f delta f, minus because they are in opposite directions. Now, compare this with alpha x plus beta y that we did in the previous slide. If you note, x and y were random there. So, x and y are replaced by delta s and delta f respectively, and alpha and beta are replaced by q s and minus q f. Using the formula that we derived in the previous slide, we have the variance of delta I, variance of the hedged portfolio, that is hedge plus the principal plus the exposure, exposure plus hedge together constitute the hedge portfolio, is equal to alpha square into variance of x square plus beta square into variance of y square minus, because beta is qf is minus beta or beta is equal to minus qf. So, whatever it is. So, minus 2 rho is the correlation between x and y, correlation between delta s and delta f. Rho is the correlation coefficient between delta s and delta f. Q s, q f, which are nothing but alpha and beta with this minus sign of course, into sigma delta s delta y, precisely the formula that we derived in the previous slide. Now our optimization criteria, what is our optimization criteria? The optimization criteria that we are adopting for this particular analysis is that the variance, equivalently the standard deviation, the variance of this portfolio variance. Once you have the exposure, you put a hedge on it, and you want that the two together, the variance of the value of the two together should be a minima, should be minimum, as less as possible. Therefore, what we do? We differentiate this expression with respect to what? With respect to what are we trying to determine? Qs is given to us, delta S and delta F are random. In fact, these quantities are also given to us. All these quantities are given to us. This is given to us, this is given to us, this is given to us, Qs is given to us. Where is Qs? Qs is also given to us. This is S, I am sorry. So, Qs is also given to us, Qs is given to us, sigma square delta S is given to us, sigma square delta F is given to us, rho is given to us. So, these quantities are known. So, what is the variable that is within our control? The variable that is within our control is the position that we take in the futures market for instituting the hedge, that is QF. How many contracts or how many units in the future market that we need to either long or short in order to create the most effective hedge. That is what is to be determined, and that is what is unknown, that is the degree of freedom. So, we differentiate this expression with respect to the degree of freedom, which is QF, and simplifying this, when you equate this to 0, what we get is QF is equal to rho sigma delta S upon sigma delta F into Qs. Sigma delta S, when you put this, differentiate this expression with respect to QF, here you will get 2 QF into sigma square delta F, here you will get minus 2 rho Qs sigma delta S sigma delta F equal to 0 when you put, and you simplify, do a bit of algebra, you get QF is equal to rho sigma delta S upon sigma delta F into Qs. Now, this expression, as some of you may be knowing, beta of x y is given by rho x y or beta y x rather, beta y x is given by rho x y divided by sigma y upon sigma x. Rho x y, please remember rho is symmetrical in x y. So, whether you write rho of x y or rho of y x, it does not matter. Beta of y x is equal to rho x y sigma y upon sigma s. So, here what are we having? Rho of the correlation between these two multiplied by sigma delta S sigma delta F, and this is nothing but beta delta S delta F. The regression coefficient, the slope of the regression line between what? The slope of the regression line, please note, it is beta delta S delta F. So, the regression is between delta S as the y axis and delta F as the x axis. Now, this is very important, and this expression, this regression coefficient is also sometimes known as the hedge ratio. Beta delta S delta F is sometimes known as the hedge ratio H. The specific definition, now since I have introduced the term hedge ratio, let me explain it. The hedge ratio is given by Q of F upon Q of S. The quantity in the futures market that you are proposing to take or that you are required to take in order to establish the hedge divided by Qs, which is your exposure. This is the universal definition of hedge ratio. In the specific case, of a minimum variance hedge, this expression turns out to be beta delta S delta F. Let me repeat again for the sake of clarity. This part, the right hand side, is the universal definition of hedge ratio. Hedge ratio is defined as the quantity in the futures market divided by the quantity in the spot market. That is the definition of hedge ratio. However, when we do a hedging which is based on the principle of minimum variance, we arrive at, through deduction, we arrive at the fact that H is equal to the regression coefficient of delta S with respect to delta F. Another point, let us continue briefly. Another point, if you take the second derivative, if you do the second derivative of this expression, you find that the second derivative is positive, is invariably positive, is essentially positive, as you can see here. The second derivative is positive, which confirms that the value that you have obtained here of the corresponding to the variance is a minima. In other words, this expression, in other words, if you take q f equal to this value, q f equal to this value, you end up with the hedge that has the minimum variance. So, to summarize what this is a very important point. So, let me summarize it in 1 minute. To summarize this, if the criteria of measurement of risk is variance, and therefore, if you desire to establish a hedge that aims to minimize this variance, because minimization of variance implies minimization of risk, assuming that you are using risk as you are using variance as a measure of risk, then you end up with a certain quantity in the futures market, which is given by the regression coefficient into the quantity of your exposure. We will continue after the break. Thank you.